Welcome to Talk Tickers, your essential summary of the critical moments from earnings calls you really need to know about.
Hey there.
Today, we're digging into the Q3 2025 results for Indie Semiconductor. That's ticker NDI. They had their call after the market closed on November 6th.
Yeah, and our mission today really is to try and figure out what happened here. There was this, huge disconnect between the company's strategic story, which sounds pretty good multi-year, and how the market reacted almost instantly.
Instantly is right. It was brutal.
The stock just tanked. And we need to understand, why that happened. Where did that pain come from?
It was intense, wasn't it? We saw it drop, around 17.6% in after hours? That's a massive move.
Huge. Especially when you think about what the options market was expecting.
Exactly. The implied move was only plus or minus 13.7% before the call.
Right. So the actual sell-off blew past that. Tells you the market just zeroed in on the negatives, didn't it?
Completely ignored the long-term picture, it seems.
Well, let's look at the immediate numbers first, the stuff that likely triggered that reaction. Non-GAAP EPS came in at negative 7 cents.
Yeah, and the street was looking for something a bit better, right? Like negative 5 or 6 cents.
Exactly. So a miss there. And revenue, $53.7 million, also a bit short of the $54 to $55 million consensus. Pretty much flat year over year.
Okay, so a miss on top and bottom line. Never great optics.
Nope.
But, you got to look under the hood sometimes. They are making progress on tightening things up operationally.
That's true. The non-GAAP operating loss, that narrowed quite a bit, down to $11.3 million from, $16.8 million a year ago?
Yeah, big improvement there. And the non-GAAP gross margin was still pretty solid at 49.6%.
Right, that 49.6% margin, that's important. It shows their product mix strategy is generally working. But, when growth stalls, even a little.
Investors get nervous. They look for other signals.
Exactly. And management seemed keen to show their focus. They announced Naisi Wu as the new CFO, effective immediately.
Right, signaling continued focus on the finances, on the operational side.
And they're making bigger structural moves, too. That planned divestment of the China joint venture, Wu.
Ah, yes, the Wu sale. An asset purchase agreement, supposed to bring in $135 million cash, net of taxes.
And this is a really key strategic point we need to unpack. This sale, they expect it to close late 2026. It's not just about the cash infusion.
Okay.
Management was very clear. Selling Wu is specifically meant to improve their overall gross margin profile and lower the break-even point for the whole company going forward.
So Wu is dragging margins down.
Essentially, yeah. Is margin-dilutive. So selling it off lets them focus purely on the high-growth, higher-margin stuff like ADAS and connectivity.
Yeah.
It de-risks things a bit.
Okay, that context makes the updated strategic backlog number even more interesting then. They bumped it up to $7.4 billion.
Yeah, up from $7.1 billion a year ago. Shows they're still winning designs, which is crucial.
And didn't they adjust that number too?
They did. And this is super important. That $7.4 billion is after they pulled out $1.3 billion that was tied to WUI.
Ah, okay.
They said the timing on that Wu revenue was just too unclear. So the $7.4 billion that's left, it's cleaner, it's better defined, and it represents a higher margin mix of products, mostly ADS, radar, and vision driving that.
Okay, that makes sense strategically. But if you're an investor seeing the Q3 miss, a big backlog number is great, but it's still future revenue.
Absolutely. That's the constant tension.
How reliable is that number if you miss this quarter's target? That's always the question.
It is. And management's answer seems to be diversification. They're pushing beyond just core auto. They mentioned the backlog now includes quantum computing, communications, even humanoid robotics.
Robotics, really? Like Figure.ai and Unitree?
Yeah, they mentioned shipping content to them. Now, the revenue from those is tiny right now, less than $1 million for 2025 probably.
Okay.
But shows their tech has legs outside the traditional auto cycle, optionality.
Right. Okay, but let's get to the elephant in the room. Q4 guidance. That seemed to be where things really fell apart.
Yeah, this is where the pain point really showed up.
Yeah.
Revenue guidance, $54 million to $60 million. Midpoint, $57 million.
Yeah.
Okay, maybe a little light, but not disastrous.
But the margin guidance.
Exactly. Non-GAAP gross margin guided down sequentially, only 46% to 47%. That's a noticeable step down from the almost 50% they just did.
So why? Why the margin dip? What happened?
Okay, this was the single biggest issue on the call. They were very specific. They quantified an estimated $5 million revenue shortfall just for Q4.
$5 million. Why?
because of industry-wide shortages in packaged organic substrates.
Okay, hold on. Packaged organic substrates. Let's break that down for people. What are they and why the shortage now?
Sure. So basically, the substrates are like the foundation board inside the chip package. They connect the actual silicon die to the pins or balls that connect to the main circuit board. Really essential component.
Got it. And the shortage.
Management called it a shock. And they tied it directly to the absolutely massive demand for large language model AI chips.
Ah, the AI boom effect.
Precisely. All that demand for AI compute power is sucking up the available capacity for these high-end organic substrates. Capacity is being redirected away from companies like Indie towards the AI giants.
Wow. So AI is indirectly pinching their automotive supply chain in the short term.
That's the story. And it explains the $5 million revenue hit.
Yeah.
And they said that sequential gross margin dip. That's purely because this shortage forces them into an unfavorable product mix. They can't ship some of the higher margin stuff they plan to.
Crucially, what's the timeline? When does this get fixed?
They expect this specific substrate issue to be resolved during Q1 2026. That timeline is, well, it's everything for the bullish view right now.
Q1 2026. Okay, so a couple more tough quarters potentially on that front.
Seems likely. But while that's happening, they are controlling costs. They guided operating expenses down for Q4 to about $36.5 million, managing what they can control.
Okay, let's pivot back to the positive side then, the design wins, because that's the future growth engine. They sounded really upbeat about radar momentum.
Oh yeah, huge news there. A Tier 1 partner publicly launched their Gen 8 radar solution, and it's built on Indie's 77 gigahertz chipset. They called it a momentous milestone.
Momentous? Why? What does Gen 8 do?
Better performance, basically. It enables detection way out beyond 300 meters, and it's apparently a 30% performance boost over the last generation.
30% is significant. For autonomous driving, that means seeing farther, reacting faster.
Exactly. Safer systems, more competitive ADAS features, and this Gen 8 platform, expected to be very high volume.
Which actually creates another problem, or at least another cost right now.
Yeah, good point. Because of that expected high volume, they said they're accelerating their second sourcing strategy.
Meaning
They need to spend more money now in Q4 on OpEx to qualify additional factories and testing houses, specifically outside of Taiwan and China.
Ah, the geopolitical angle, the whole China for China, not China for not China supply chain thing.
You got it. It's a strategic necessity these days. So they're spending today to de-risk tomorrow's massive revenue stream. It hurts the bottom line now, but secures the future. A classic trade-off.
Makes sense. And it wasn't just radar, right? They mentioned vision wins too.
Yep. A design win for their image signal processor, the ISP, for multi-camera setups. This one's with a major North American robotaxi company, targeting 2026 deployment.
Robotaxis need tons of cameras, so ISP is critical there.
Absolutely. Processing all those video streams reliably. And they also mentioned custom connectivity chips shipping to a big North American EV maker, ramping in the first half of 26.
Plus that little dip into quantum.
Yeah, the DFB lasers, distributed feedback lasers for quantum computing and key distribution, started shipping late Q2. Like we said, revenue is tiny, less than $1 million this year probably, but it shows they're playing in these really advanced, potentially high-value future markets.
Okay, so bringing it all together, the market freaked out about the Q3 miss, the revenue shortfall, the Q4 margin dip.
All driven by that quantifiable, supposedly temporary substrate shortage, which is kind of an external shock tied to AI demand.
Right. While management is pointing at everything else, the cleaner balance sheet and margin profile from the Woo sale, the massive $7.4 billion higher quality backlog, and these huge wins like Gen 8 radar and the robotaxi ISP.
Yeah, they're basically saying, look past this temporary supply glitch. The long-term story is intact, even strengthening.
Okay. That sets us up perfectly for our segment. This is not financial advice. Let's be crystal clear. We are not telling you to buy or sell anything.
Definitely not. We're just exploring a potential scenario, a high-risk idea that someone might consider based purely on the information from this call. Think of it as a thought experiment.
Okay, so the core idea, the thesis, is that the market's reaction, that 17% plus smackdown after hours, was maybe an overreaction.
That's the premise. An overreaction to a temporary problem, that $5 million substrate headwind, which the company expects to resolve in Q1 2026. The market panicked about the short term.
And missed the bigger picture improvements.
Potentially. The argument would be the market failed to properly price in, three key things. One, the coming Gen 8 radar ramp. Two, that significant robo-taxi design win. And three, the structural margin improvement from getting rid of WUI.
So if you believe that thesis, what kind of trade might someone structure? Again, purely hypothetically.
Well, given the timeline for the substrate recovery is Q1 2026, you'd probably look at something long-dated, maybe an out-of-the-money option strategy, like a call spread expiring sometime later in 2026, maybe Q3.
Betting on a recovery and a re-rating.
Yeah, betting on a valuation reset. You'd need two things to happen for it to work out. First, they need to actually hit close to that $57 million midpoint for Q4 revenue, proving they can execute despite the substrate issue.
Okay, stabilizing execution.
And second, you need confirmation probably early next year, maybe on the Q4 call or Q1 call, that the substrate supply is easing up and management starts guiding more confidently towards converting that big backlog. That could trigger a relief rally.
And the risk is capped with a spread, right?
Exactly. Your max loss is the cost of the spread. But the potential upside is tied directly to them navigating this specific supply shock and getting back on track with their growth story. It's a bet on strategic execution eventually overcoming these quarterly headwinds.
Got it. High risk, high potential reward scenario based on believing management's timeline.
Precisely. So to recap the whole situation, you've got this Q3 miss, a Q4 margin pinch blamed on an external supply issue linked to AI demand.
Set against this backdrop of a huge, cleaned-up $7.4 billion backlog, major design wins like Gen 8 radar and robotaxi vision that solidify their long-term position.
Right, that's the core tension investors are wrestling with right now.
Which leaves us with a final thought for you, the listener, to chew on. Management is actively choosing to spend extra money right now, OPEX money, that could maybe make their quarterly losses look a bit better.
But they're spending it instead on securing that second source supply chain for the huge radar programs, making sure it's geographically compliant.
So the question is that spending worth it? Are those costs today incurred to build a robust, diversified supply chain for the future worth the hit to near-term profitability? Will the market eventually reward that kind of long-term strategic thinking, even if it adds pressure right now?
Or is it just R&D spend disguised as supply chain work? Something to think about.
Definitely something to mull over. Thanks for joining us for this deep dive into the NDI earnings call.
Always interesting.
And remember, this conversation was purely for informational purposes. It is absolutely not financial advice. Do your own research.